Thank you for joining. This is Larissa Fernand, and today I am in conversation with Ihab Dalwai, Senior Fund Manager at ICICI Prudential Mutual Fund. Ihab manages multiple funds across the different mandates, but his investing style is consistent, and that's what we are going to dig in today. Ihab, thanks so much for joining me.
Thank you for having me.
So, Ihab, can you start very briefly by just describing yourself as an investor?
See, what I've observed of myself over these years and how I've evolved as an investor, I can classify myself as a counter-cyclical or a non-consensus investor broadly, as a style of investing which I've adopted and learned and practiced over these so many years.
So when you say that you are a counter-cyclical investor, okay, that means a lot of your alpha comes from the sector calls. So can you name some other potential sources of alpha?
See, sector rotation or sector allocation, obviously, like you said, plays a key role in alpha generation. But having said that, while I'm working in ICICI Prudential Mutual Fund, we have a very large research team covering large number of stocks. So the high conviction bottom up ideas of these analysts also form part of the portfolios which I manage. So clearly, a bottom up approach of investing is also visible in the funds which I manage. So stock selection also has been a source of alpha for the pure equity schemes which have been managing.
So what risk mitigation techniques do you use then when picking up the stock? Margin of safety, position sizing. Tell me something about you constructing your portfolio.
See, for me, the definition of risk is to a great extent downside protection. And when I say that I follow a counter-cyclical or a non-consensus style of investing, I think once one adopts this approach for investing, to a great extent, this risk is mitigated. So if I would explain this a bit more further, so non-consensus or counter-cyclical investing is generally trying to invest in stocks or sectors which are currently beaten down, where expectation of either or the earnings growth expectation or recovery expectation is low, ownership is low. So once you start entering into these sectors or segments, the potential downside is limited. And as and when the view plays out or the thesis plays out, you gain out of the upside. So I think the risk mitigation is inherently a part of the style, and that's why I like this style.
How do you evaluate where you are in the cycle then?
So because it's called a counter-cyclical approach, so it has one needs to develop an understanding of cycles. So one way of determining where are we in the cycle is just to plot the historical margin profile of either the industry or the company, and then trying to figure out where the company is in that margin profile. So if it is under earning, clearly you're in the lower end of the cycle. If it's over earning, you're in the higher end of the cycle. Other way of looking at it is from a capital cycle perspective as well. So if you see a lot of players entering into this particular segment, or if you see a lot of investor interest in this particular segment, then it's also an indication that we are in the higher end or the upper end of the cycle. But when you see a lot of players exiting a particular industry or a segment, or very little investor interest, most of the investor portfolios are underweight in a particular sector or segment. So it also indicates that we're in the lower end of that cycle. Is through profitability and clear understanding of the industry dynamics. And second is also to some extent behavioral as well, trying to figure out how are corporates taking decisions from their capital allocation, how are investors thinking of that particular sector or sector.
So when you stack up or you offload a particular stock, you do it gradually as the cycle moves?
Yes, because I think it is difficult to predict or time the bottom or the peak of the cycle. So I think a gradual approach is ideal if one is following this process. And I would say like averaging on the way down while you're buying, or selling gradually on the way up as you want to exit the position. So I strongly believe in a gradual approach or a process while adopting this strategy.
And you're very comfortable if you really like a stock. If its fundamentals are excellent, you have no problem exiting it and coming back again later, or you hold it.
So generally, like I'm not a great believer in a buy and hold strategy or buy or forget strategy. I believe as an institutional investor, one can have a time frame of 3 years or slightly longer for the thesis to play out. Because what I strongly believe is that, especially while adopting this strategy, is that having a 3 to 5 year framework is good. As and when, like you mentioned, if the thesis has played out, the stock is trading closer to its 1 year fair value, or internally we try to assess what is the 4 year fair value also of a particular company. So if this company starts trading closer to its 4 year fair value, I think it is an indication that one needs to exit, and one needs to find the next segment of winners or next set of winners where we can deploy or adopt this strategy.
What if you enter a sector way too early and your bets take a long time to play out? How do you manage the investor expectations?
It is very important how not only the investors but also how the ecosystem supports you, because we also are governed by board. We also have to like report to our CIO. So it is important that how the ecosystem supports you when a particular sector or segment is taking slightly longer to play out than what we had envisaged. But broadly, what I think is that from a portfolio perspective, at least some part of a portfolio should be delivering at a particular point of time. It is quite rare that your entire portfolio is not delivering at a particular point of time, because you would have invested in one segment or one sector maybe 3 years earlier. So that should be delivering either, or 3 to 2 years earlier. So that should be delivering today. Something which you've invested today, you're giving it time. I would say almost a year for it to normalize, or for our investment thesis to play out. So at any given point of time, some part of a portfolio ends up doing well. And luckily, like where I work, our CIO Shankaran Naren, he's been a legend in this particular style of investing. So he understands the process. He understands the time frame required for this thesis to play out. So I think it becomes relatively easier for us as portfolio managers when you have a CIO who believes in this thought process.
But what if you and your colleagues disagree on a particular stock, so especially in the entry and exit timing? Then how do you all solve that issue?
So we have a lot of internal discussions and debates to figure out, are we too early in entering or are we too early in exiting as well. So more often than not, one ends up being a bit early in both the segments of entering and exit. But I think discussing with a person who has a similar thought process helps in timing the entry and the exit better. So I think it is more of a collaborative and a discussion process through which we try to improve the process of investing.
Would you be able to cite an example where you were really right on the timing, or you went a little wrong and you had to find your footing again?
So I may not be able to give a stock specific example out here, but I would say that where I think one has to be very clear out here is that what we think is cyclical can end up being structural as well. So if something is on a structural decline, we would think that it is a cyclical decline and we would want to buy it. But then ultimately doesn't recover. So for that, I think what we need to understand is that sitting here in India or in the emerging market, it is relatively easier to figure out what sectors or what segments are are the sunset sectors or dying sectors globally. So we need to be very sure that similar fate would eventually follow in the sectors which are there in India as well. So we can build a lot of reference from global sectors to try to figure out whether it's a structural decline which the companies may face. So that bifurcation is important. And this is something which I also have learned over a period of time. It's not that I've not made mistakes in differentiating between structural and cyclical downturn, but it is something which we've added in our checklist and something which we keep evaluating.
Give me some pointers when you're selecting a stock, some issues in your process that really make your stock process, your stock picking process very dependable.
So, the framework which we've adopted, like which I've adopted for this particular investment style, is that the hunting ground generally has been one needs to figure out whether the sector or stock has been an underperformer. Like a typical filter can be like a 3-year underperformer. So that is a good hunting ground to identify sectors or stocks which fit into this framework, because ultimately the stock has underperformed because things are not doing well, or the operating performance is not that good. Then I think the way we approach is that we try to figure out internally what is the research view out there. Is the analyst positive on that particular stock or segment? And generally, a typical checklist is something which I like to follow. As well as that balance sheets tend to need to be better, because what we have observed is that in this process of investing in a counter-cyclical framework, generally for the company to survive and recover in the industry onslaught, which would have been undergoing at that time, they need to have a very strong balance sheet to recover. Because the worst outcome can be that the company dilutes equity at the bottom of the cycle. Then for the existing shareholder, the dilution is quite high. So balance sheet is very important. Obviously, capital allocation is also very important. The company shouldn't be over diversifying. It should not. It should have a disciplined process in capital allocation. And one thing which I've observed, especially in India, is that there has to be some growth in the sector in which you are investing. So generally, this approach helps when there is some growth in the sector. If you're trying to adopt this strategy in a no growth sector, at times the thesis doesn't play out. So there has to be some element of growth, and once that is in place, I think obviously good management and all that is there, goes without saying. So a bit of growth, strong balance sheet, good capital allocation, and generally, if you're investing in a in a down cycle or in a weak cycle, evaluations are obviously attractive. So that is important. One more important thing is that how is, like I mentioned earlier, how is the streets expectation regarding that particular sector or stock? So if it is muted, it is good, because a lot of growth is not built into that stock. So if our internal analysis shows that eventually this sector or stock would recover, I think there would be a huge potential of earnings upgrade from the sell side or the broking street as well.
Okay, so let's say you pick up a stock, which the cycle is now, it's going to go on an upswing. I mean, the tide will carry every boat with it, right? So you could make some great tactical bets too, even if quality is an issue. Would you do so?
That is true. That is true. But like you mentioned earlier, like it is difficult to time how the cycle recovers, right? So in that bottom of the cycle, for that company to survive is very important. So sticking to good quality companies in the bottom of the cycle is an ideal way of investing in this framework. But your point is right, because the biggest delta will be in the lowest quality stock in that particular sector. But while managing institutional money, I think it is prudent to be in the highest quality stock at the bottom of the cycle, though the returns may not be as high as the low quality stock, but eventually it beats the benchmark. So that is the goal. Yeah.
You know, in this ongoing debate about cash, that the investor just wants you to make money. He doesn't care how much cash you hold in your portfolio. And the other side is a fund manager should not hold cash because the investor is doing his own asset allocation between cash and equity or debt. How do you balance this view?
So for my pure equity schemes which I manage, generally I don't keep cash in those strategies because the end goal is to do better than peers, beat the benchmark. So there, at least I try to de-risk the portfolio by on an active basis, trying to sell the stocks which have delivered returns, trying to enter into the underperforming set of stocks which are expected to do well going ahead. So that active management, I feel to a great extent, de-risks the portfolio, does a good job of what contribution cash as a strategy can do in a pure equity strategy. But for an hybrid strategy, I'm an active believer that it has to be dynamically managed. There is no need to have a static allocation to equity and cash. uh, Through a dynamic asset allocation, you can generate alpha because what people don't value a lot is the tremendous value which cash can bring on the table in the when the markets have corrected, right? Because what we've seen historically also that market multifolds from the bottom of the market levels to when it normalizes as well. So if you have an ability to deploy cash at that phase of the market, that cash is has tremendous value. And today, when liquidity is good, I think the cash value is not respected to a great extent. But when liquidity is not there and the value of cash is significant because you can get very good bargains in the market and you can deploy that cash. To switch when the market conditions are bad is very difficult because your existing portfolio also will not be doing that great. So if your ability to maneuver, like if you are today in large cap and you want to switch because you know that small caps are very attractive and can do better than large caps, it is psychologically difficult because your large caps have not done well. How can you switch, sell that large cap and enter into small cap today? I think having a cash strategy there, especially in the hybrid, can help you deploy large sum of money in mid and small cap when markets are not good.
And in a pure equity strategy, is there any internal cap that you have on cash allocation?
So generally we don't end up having cash in those strategies, but whatever the particular scheme says from an SID perspective, we would adhere to it. But we don't like having some cash is okay because, like I mentioned, it helps portfolio management better because you can get certain tactical opportunities in the market to deploy that cash. But we don't have any high cash strategy in, at least I don't have a high cash strategy in the pure equity schemes which I manage.
Are there any sectors you would completely avoid?
I'm not a fan of just not looking at any sector because I believe that sectors also go through its ups and downs. So if a sector is not doing well, the strategy forces me to look at that sector. I cannot say that I'm not an expert in this sector, so it's not something which I can understand. The advantage, like I mentioned earlier, is that we have a very large and strong research team. I have my peer fund managers who also have who have been sector specialists in various other sectors. So borrowing their conviction or borrowing their understanding also helps to a great extent when sectors are not doing well. So I'm quite open to look at most of the sectors, but the condition generally has to be that it has to do badly in the current phase or it has to underperform the broader market to attract my attention.
When you started off as an investor, did you gravitate towards this form of investing, or you started off differently and became one?
Yeah, so when I started as an investor, like obviously this has been my first job. I started as a retail investor. I did not, to a great extent, believe in cycles then as a retail investor. But obviously, this being my first job, I have been significantly influenced by the style of investing of our CIO Naren. So his style of investing has an significant influence on the way I look at market. So this is something which I've built over this course of period. This is something which I've learned from him also, and I think and I'm a believer in this style as well, because I've seen this style perform very well over at least a couple of cycles. So because I've been in this company for almost 13 years now, so I've seen this style. There have been times when the style, like you mentioned, can take some time to deliver returns. But if one is convinced in the sector which they have invested in and have an ability to hold on to that sector or that position for slightly longer, I think it ultimately delivers return.
And how many years have you been managing money?
So it's been almost now more than 6 years, 6 to 7 years I've been involved in the domestic schemes. Yeah.
Has there been any investor that you read a lot upon that has influenced your style of investing?
So I think there's something which I've learned, like I mentioned earlier, domestically. Learning from Naren is something which has influenced me significantly, but nothing specific from an international context is something I would say.
It was. Okay, I think that's it. Thank you, Ihab. It was lovely chatting with you.
Yeah, sure, sure. Thank you so much. Thank you.
This is Larissa Fernand. I was chatting with Ihab Dalwai from ICICI Prudential Mutual Fund. Thank you so much for listening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.